Ladies and gentlemen, my name is Greg Michalowski from ForexLive.com. Today's date is May 5th, 2016, and tomorrow's date is May 6th, 2016, and it's a Friday tomorrow. And what happens on the first Friday of every month? We have the U.S. employment report coming out. And so this report is going to take a look at that U.S. employment report. I'm going to tell you how I'm going to trade it, or how I would look about trading this report tomorrow if things go my way. First off, I just put up an infographic with a look at the major trends in the U.S. employment statistics, and we have some things that you should be aware of going into that report. First off, the unemployment rate is expected to fall to 4.9% from 5% in March. We're expecting the non-farm payrolls to come in at 200,000 versus 215,000. We're expecting the average hourly earnings to come in at plus 0.3 for the month and 2.4% for the year on year. Those are the expectations of the major portions of that report. Is it all that's in that report? No, there's other things in the report, including the revisions to not only March, but February. There's also going to be things like temporary jobs and where the jobs are being created, and or is it goods producing or service? What are the manufacturing jobs doing? All these types of things are going to go into the big huge pot, and the market's going to determine, and you have to determine whether or not it's more bullish or it's more bearish. If it's more bullish, that is, it's stronger, the dollar should go higher. If it's more bearish, what should the dollar do? It should go lower. And so understand the fundamentals that go into what is bullish and what is bearish. If the numbers come out as expected, near these levels right here, would you expect it to be more bullish or bearish? We don't know. I would expect the market to chop up and down as a result of that. So in that case, we probably want to shut off the screen and go away for the weekend, because we don't like to trade choppy markets. We like to trade trending markets. And the unemployment statistics have that potential to trade a trending market if they're a surprise, okay? If they're a surprise. And if they're a surprise, or they're more bullish and more bearish than expectations, then we have the opportunity to use our trading acumen to trade the market. Now, what also happens at 8:30 a.m. As far as risk goes? Well, risk is increased, okay? In fact, it's at the highest level it will ever be. Why? Because there are three types of risks that we face every time or in the market. The first type of risk is market risk. That's that the price moves up and down, with buyers and sellers buying it. And if there are more buyers than sellers, the market goes higher. If there are more sellers than buyers, the market goes lower. That type of risk can be hedged away by trading, by using technical tools. So we may lean against a moving average. We may lean against a trend line. And if the price stays below the trend line, we may we'll hope that the market moves lower and our short position makes money. If it moves above that trend line, we get out. So we're able to hedge our market risk, the market price risk, by using technical tools. And if you don't use technical tools, I strongly encourage you to start using them. Otherwise, you're going to be, you might get yourself in a lot of trouble. So that's market risk. What are the risks that we face in the market? Well, there's event risk. And what's event risk? Event risk is like the employment statistics. Do the numbers come out at 250,000? Does the non-farm payroll jobs come out at 150,000? Does the unemployment rate go up to 5.2%? Does it go down to 4.7%? What do wages do? What do the revisions do to the prior months? What does temporary jobs do? What's the mix of job? What's the manufacturing jobs? All those things are events, part of the event, and you can just imagine that there's a lot to interpret. And so the event risk is sky high during the employment report. Sky high. It's probably not going to get any higher other than maybe a interest rate decision or interest rate statement by a central bank. So understand that that type of risk is high. And when event risk is high, what happens to the liquidity risk? Liquidity risk is that the market gaps. It's that it's that your broker widens a bid offer spreads. It's that the market chops around. It goes down 100 pips or 50 pips and then chops up 30 or 40 pips, or even all the way back up. It goes down 50 pips, comes back 50 pips. You have to be aware that the liquidity risk is going to be high during the unemployment report. So with all that type of risk at sky high levels, what is it like? I liken it to getting in a barroom fight where there's a bunch of mean people in that barroom fight. They're breaking glasses or breaking bottles, and they're using them as weapons, and you don't know how to fight that way. And you can get yourself bloody in a very quick minute. And so if you want to trade those types of markets, I liken it to gambling. getting in a barroom fight with your life, okay? So if you want to do that, go right ahead, have fun. If you win because you get lucky, it's blind luck, then go on Twitter, tell everybody in the world, come back on our site, comment how you made a lot of money because you knew the employment number was going to come out stronger or weaker than expectations, and good fortune to you. But it's gambling. It's gambling to me. If it's not gambling to you, then that's okay with me. I don't care. But so how do you trade this report? And the way that I would trade it is after the fact, after the event liquidity risk is over, when you just have market risk, and then you can use technical tools to hedge yourself by leaning against those technical tools. So what are those technical levels? So what are the technical levels that are important here in the euro versus US dollar? I'll use that as a proxy as my example. And if we take a look at the euro versus US dollar on a daily chart, and we were to go back and look at levels here that are of significance, I'm going to point out a bunch of levels through here that are very similar. You see all the highs, the swing highs here, swing high, swing high, swing high. Let's discount that. Swing high, swing high, swing high. Every one except this one right here where it was half a day or less than half a day to the upside and then back down to the downside, moving all the way to lows here. Every one of these swing highs occurred in this yellow area, this 30 pip range between 114.35 and 114.65. Is that of significance? Is that a coincidence? No. Traders were leaning against those levels. They were selling here and putting a stop above that level, right here. And as long as the price moved down, they made more than what they risked on the trade. And that's what traders do. So they use the technical levels to define and hedge their market risk. And if they're right, they make a lot. Or if they're wrong, they lose a little. If they're right, they make more than a little, is what I like to say. So what happened here, where the price moved sharply to the upside? Well, stops were triggered, the market moved sharply to the upside. Why? Because it went above that level. Okay, buyers came in, they stopped it and moved above it. It didn't happen here, so traders got out here. Traders who bought here could have sold here and made this amount. Okay, so that's called a fail break. You look for those fail breaks too, and we'll look for them tomorrow as well. So let's move forward into this month. What happened this month? What happened the last week, as a matter of fact? Well, the market moved higher. The market broke above this level, and we had stops. We saw stops trigger and move their price to the second highest level going back to beginning of 2015. Our highest price since that time came at 117.11. We got to 116.15, and the market reversed itself. There's a reason why it reversed itself. If you go to the weekly chart and you look at the 100-week moving average right here, the market got within about 19 pips of that 100-week moving average and reversed itself. So that's why we found sellers. Traders were leaning against the 100-week moving average. Anyway, let's go back to our daily chart right here. And what do we know about where we are right now? Well, we're currently trading at about the 114 level, right? 114 even is about where we're trading currently at the moment. And so if the numbers should come out more or weaker than expectations, what can you expect the euro to do? We can expect it to go higher. Why? Because the dollar would go lower. And guess what would be the key level to get and stay above? The 114.65 level. If we can get above that level and stay above that level, what should we do? We should move up toward 116.15 and then maybe even up to 117.11. Either tomorrow, the next day, or next week, or whatever. That would be where we would expect to go. And if we get above that level, we can go even higher in the euro versus US dollar. It's a matter of staying above what is once resistance, staying above that level, moving to the next level, and staying above that level, and stepping forward into the trade. And so that's what we look for. We would look for a move above the 114.65 level. If we get above that level and stay above that level, that would be more bullish. Now, what would happen if you were, if the market was, the number came out weaker, and we saw the market move up, and we moved above the 114.65 level, and we bought right there, and the market goes higher, and then the market reverses itself and comes back down? Would you still be long if the market comes down to here? And my answer would be no. Why would you be long? Because this is a line in the sand, folks. As long as the price remains above that level, it's more bullish. If it goes back below it after going above it, it's more bearish. So just get out and shut off your screen and go away for the weekend and come back on Monday when the risk and the market is less choppy. So we don't want to see that happen. We don't want to see a market come above that level and then reverse itself back down. We don't want to see that, so just stay away from it. This level should be key. As long as it stays above it, it's more bullish. Now, let's take a look at the other side. What happens if the number comes out much stronger than expectations, okay? And we start to see the euro go to the downside, the dollar gets stronger. In that case, what are our key levels that we need to focus on? And I'm going to go to the 4-hour chart here first, okay? And if I take a look at the 4-hour chart and I go back to the last employment number that came out, and that was right here, okay? You can see what the market did. It went right up to our yellow area. This is the same yellow area. And we came down to another low right here. I'll talk about this level in just a second. But look at what happened through the first 13 days of the month. This is 13 days. The market couldn't get above that yellow area, could we? We came up to it here. We came up to it here. This is the low of it. We came up to it here. Couldn't get above that level. And what happened on the downside? We found a lot of support near this area right here. So we were trading between remembered areas, a level above and a level down below. We eventually moved our way above and below that level, but I'm gonna earmark this area right here, this yellow area, which actually goes back to here as well, as a key level to get to and through. Just like the level on the top side was a key level to get above here, the 1465 level. This area right here is a key level to get below. And in addition to not only having this remembered line right here, we also have the 200 bar moving average on the 4-hour chart, this 4-hour chart. That's a green line, and the 200 bar moving average on the 4-hour chart, that's a blue line. And that comes pretty much where the yellow area is. So if we need to get above the 1465 level and stay above on the top side, on the downside, we need to get below this area right here. We need to get below this 1329, 1330 level and stay below that level. If we do that, our next target would be near our low price here at the 112.14 level. And if we get below that level, we're going to be heading down toward these key levels right here. This is the 100-day moving average. This is the 200-day moving average. Key targets. And that would come if the number is unequivocally more bullish. If we get a very strong number, high earnings, low unemployment rate, that is where we would be heading toward. Maybe not tomorrow, but going forward. Now I want to take a look at this 112.14 level right here off the daily chart, because I think it's a key level tomorrow. In addition to this level being key, which is about 60 pips from where we are right now, I think this level right here is also key. So this is step number 1, this is step number 2. Now why is that level key? I'm going to go to the daily chart and remember the 112.14 level. And if I put the Fibonacci retracement from our low price here to our high price here, what is the 50% retracement level? 112.18. Here's our 14 low. Is that close to the 14 low? Yes. So this is going to be such a key level to get to and through. It would be a target that we'd expect to go get to if we get below this 113.25 level, that area above it. So keep that level in mind. Here's our 100 and 200 day moving average down here. That ultimately is where we would look to go if the number comes out much stronger than expected. So again, we need to get below this level right here. We need to then get down to the 112.12 level, and then we're heading down to the 100 and 200 day moving average. On the top side, if we get above this level, we're going to head to our high. We're going to head to this 117.11. That's the hope. As long, it has to be much stronger, weaker than expectations. But those are the targets that we'd go off of. And if we get through that level, then we move further to the upside. So, folks, it's all about what the expectations are. It's all about whether it's much stronger or weaker than the expectations. It's then all about the technical levels, where we can get rid of the event risk and liquidity risk, and we can just deal with the market risk and use our technical levels to hedge ourselves, to define our risk, to limit our risk, and to make sure that we're going to stay on the right side of the trade when it breaks through our key levels. If you like this video, and I know it was long, but put the click on the thumbs up on YouTube. If you didn't like it, click on the thumbs down. That's fine. It's by your feedback that we get know whether we're good or not. And then also, if you want to put a comment, feel free to put a comment. If you want to share it, feel free to share it. And at the bottom of this this post on our site at forexlive.com, there's going to be a box that says if you want to be added to our email list. Click that and put your email list in and stay in touch with us. My name is Greg Michaelowski. Good fortune with your trading. Bye-bye now.